Hi everyone, and welcome back to another episode of what's going on in the real estate market right here in Southeast Wisconsin. So we've got some new evidence, reasons to be optimistic this year that we're going to actually stick that soft landing and thereby avoid that recession that economists were predicting would happen in the third and fourth quarter of this year. Also new evidence that the labor market is strong, financial sentiments are strong, and as well as the real estate market right here in Southeast Wisconsin. So let's go ahead and dive in. So the Fed's social experiment of having one of the fastest rate hikes in history seems to be working. Like I said, we are looking like we're going to stick that soft landing. What do I mean by a soft landing? That means the raising of interest rates to slow down an overheated economy while simultaneously avoiding an economic recession. So as you can see from this graph, we are doing well. We're about at 4.13% as far as inflation, down from about 9%. And we're not at that target 2%, but you know what? We're on the right path. The real wild card is the full effect of the Fed's campaign against inflation. It's a lagging effect. What does that mean? We might not actually feel the full effect for months, a quarter, or maybe half a year down the road. So again, that's going to be a wild card that we're going to have to watch out for. As you can see from this chart, our gross domestic production, or GDP, actually grew by a seasonally and inflation-adjusted 2.4%, which actually beat out the forecast of 2%. Why is this important to a recession? Because a recession is associated with a 2% decline in GDP or 5% in a severe economic recession. So the fact that our GDP is growing, again, bodes well for the economy. So the key to a measured inflation-busting slowdown that doesn't sink the economy truly lies on whether or not companies keep or lay off workers. And as you can see from this graph, companies are making a priority of keeping workers despite economic uncertainty. And that's really good because, as you can see, layoffs, reductions in training investment, or workforce benefits, those are the least implemented or intended implementation for cost-cutting measures in the face of uncertainty. Again, this bodes well for the economy. This graph shows that the job market is actually cooling, which is what the Feds want. This, combined with a 12-month decline in inflation, in addition to unemployment, the unemployment rate ticking down to 3.5%, which is a half-century low, this combination of multiple economic factors is really, again, a good reason to be optimistic about the market. Consumer spending, another great indicator for the strength of the market, actually rose again for the sixth consecutive month, and it's actually increasing faster than inflation. This is actually a great table. What it is it's a survey of personal financial situations. And in large, the sentiment shows that the people who feel that their financial situation will stay the same is increasing. That people's financial situation will get worse is decreasing, and that people's financial situation will get better, it's also decreasing. So all in all, it's mildly optimistic rather than bullish. So what does this all mean? Well, we're getting inflation under control. Our GDP is rising. Companies are not intending to lay off their workers in mass. The job market is cooling, but it's still strong. Unemployment is at historic lows. Consumer spending is still rising and strong. And financial sentiments are optimistic, albeit not robust. They are optimistic. Well, according to the chief economist at Moody Analytics, Mark Zandi, there is a 1 in 3 chance of a recession this year, but most likely 2024 if there is one, but we have a strong chance of sticking that soft landing. What about the mortgage industry? So as you can see from this graph from Adam Data, we did have a slight uptick in foreclosure filings on a national level, but as you can see, it's nowhere near what it was during the 2008 housing crisis, and it's going to likely stay that way because of the robust lending standards that happen as a result of that fiasco, and because also lenders are tightening their standards and making credit less available. What about foreclosures in Wisconsin? Well, as you can see from this graph, Wisconsin ranks amongst the top 10 states that saw the greatest decline in foreclosures this year. This is the Mortgage Credit Availability Index, which is a broad measure for how available mortgages are across the nation. And as you can see, there is a steep decline. So what's going on is loan origination volume has plummeted, which obviously affects the profitability of lenders. So what they're doing is they're narrowing or they're cutting the amount of products, especially jumbo loans. So what this means is now not only do we have tight lending standards, we have a severe decline in credit availability from lenders. We are at a decade low as far as available homes for sale. And this is a multi-pronged issue. It's not just one thing. It's that decade-long slowdown of construction of single-family homes because builders were decimated during the last housing crisis. It's the growing population of older adults who don't want to move and will likely age in place. It's the lack of available homes for sale by would-be, or lack of available homes for sale by would-be sellers for them to in turn purchase. And it's also because of the pandemic. Many moves were accelerated. So people that planned on moving this year or next year, they moved up their plans to move in 2020 or 2021 as a result of the pandemic. What about right here in Southeast Wisconsin, right here in Walworth County? The months of inventory is at 3.14%. We have finally breached that 3-month threshold. Anything below 4 months is a seller's market. Between 4 to 6 months is a balanced market. Anything above 6 months is a buyer's market. So our absorption rate is going up. What that means is if no new homes came on the market today, how long would it take for this current demand to absorb the available inventory? So look at this available inventory, the number of new listings. As you can see, the number of new listings are actually going down, but the number of active listings is going up because they're sitting on the market longer. This is probably due to we're creating an artificially balanced market. We have so little inventory that there's no way we're going to be in a buyer's market anytime soon. But with interest rates so high at about 6.94 right now, the 30-year fixed mortgage, it's just going to be really tough for people to justify buying a home and paying all of those expenses. So again, we're having artificially balanced market, and so more homes are sitting on the market as a result of that. If you're curious about to where the median prices of homes being sold are year to date right here in Walworth County, that price is $325,700, and the current 30-year mortgage rate is averaging at about 6.9%. So that's where we are with median prices and 30-year mortgages. I previously mentioned construction being one of the culprits to having such low inventory. As you can see from this graph, the purple line, which shows new construction of single-family homes, we are below the historic average of new construction of single-family homes coming online. And as you can see, the construction of new homes has really limped, and it's barely recovered since that housing crisis. Well, what about right here in Southeast Wisconsin? As you can see, this is from the Wisconsin Builders Association. Year to date of 2023 compared to 2022, the Kenosha County has 53% less housing construction starts. Walworth County, 12% less. Racine County, they're pretty robust, but Kenosha and Walworth County, we are hurting for new construction of single-family homes. Do you remember how I said that Wisconsin is actually doing very well compared to the rest of the nation? As you can see from this graph, Wisconsin as a whole appreciated year to date of this year about 5 to 7%. So we're ranking amongst the top 20 states that has seen home price appreciation. While these high prices bode poorly as far as affordability, it is good for homeowners. Why? Because we have an unprecedented amount of equity in homes across the United States. So what does this mean? Basically, if there is a housing recession, the majority of homeowners are going to be able to weather the storm, and we don't have to worry about, again, that wave of foreclosures flooding the market in mass like we saw in the last housing crisis, which is why if we do have a housing recession, it's not going to be anywhere near the one that we saw in the 2008 housing crisis. Days on market. This is an indicator of the strength of demand. The longer days on market, the weaker the demand. The lower days on market, the stronger demand. As you can see, in May and June, we saw a rise in days on market, which doesn't bode well for the real estate market, because basically demand combined with low inventory has been propping up home prices. But it came back down. We're down to about 39.5, which is healthy for this time of the year. It's probably going to oscillate around these levels until we hit late fall. And then wintertime, of course, because of seasonality, the days on market are going to increase because nobody really likes to move when it's frozen outside. All right, the sold to list ratio. This is the big one for sellers. Why? Because if a home sells above for what it's listed for, it's going to be above 100%. If it's below 100%, that means a home sold for less than what it was listed for. So this is sitting around 100.7%. And as long as we have strong days on market, as you can see, they're coinciding, the housing market is going to sit pretty, and we may see some healthy price adjustments and corrections, but again, we're not going to see that bottom drop out to, below 90 or 85% ratio. So again, if it oscillates around that 98, 100%, again, that's a really good sign of a healthy market. All right, so what do we have in sum? We have a strong labor market, we have low foreclosure filings, we have historic low unemployment, and we have an unprecedented level of home equity. Especially here in Wisconsin, we have one of the lowest foreclosure filing rates, and we also have appreciated more than 30 other states across the nation. So again, that bodes very well. So while a housing correction is possible, an actual crash, especially here in Southeast Wisconsin, very improbable. For those of you thinking of selling a home in Southeast Wisconsin, give us a call. It is still a good time to sell because it is a seller's market. You're still going to get top dollar. Obviously not as probably robust as it was in 2021, but again, it's still a seller's market. If you don't have a home to go to, find that first, because you're going to want to make sure you have that locked down before you put your home on the market. Selling is easy. Buying is a lot more difficult. If it's in your budget, you're going to want to take care of those cosmetic and mechanical repairs, because that's going to allow you to capture top dollar. First impressions definitely go a long way. So if you again have the time and the budget to do so, make that investment. So if your home is sitting on the market for longer than 30 days without showings and or an offer, you're probably going to want to speak with your realtor. They should be speaking with you already about it, but there's something that you're going to have to discuss with them, whether it's about the terms of your contracts or if it's the price. Again, if you're working with us, we're already having that conversation with you. Just saying. For buyers, if you're going to finance, you're going to want to get that pre-approval to make sure you can act quickly. And please rate shop before you have a home under contract, not after. It can cause issues. Ask me how I know. So make sure you rate shop before you get that home under contract. When rates stabilize, if the feds stop raising rates, again, you're going to see more competition as hopefully rates come back down. So again, this is a good time to buy because this is less competition. Now, don't expect, again, a wave of foreclosures. We are at all-time lows as far as foreclosure filings. We have an unprecedented level of equity. So if you're waiting for that shoe to drop, don't hold your breath. All right. If you have any questions, we've covered a lot of material. There's my email, there's our number. Definitely reach out and give us a call. We would love to help you, whether you're buying, selling, or investing in Southeast Wisconsin, or if you just have any questions. I love questions. So go ahead and reach out, and you stay classy, Lake Geneva. Thanks for stopping by.